Welcome to today's video, where we'll unveil the key strategy for building a monster dividend portfolio. The aim? To achieve financial freedom through passive income. You're about to discover the path to a substantial and sustainable dividend portfolio where your investments work for you. I'm excited to guide you through the world of dividend investing. Let's dive in. One, using stock screeners. To start building your monster dividend portfolio, you must invest in companies that pay dividends. But how do you find them? Let's take a look. Most stock brokerages offer stock screeners that allow you to filter stocks based on a variety of criteria, including dividend yield, payout ratio, and dividend growth history. Imagine you're a new investor looking for dividend-paying stocks. A stock screener is like your detective tool. You can set criteria like a minimum dividend yield of 3%, a payout ratio less than 50%, and a history of consistent dividend growth. The screener will then generate a list of potential stocks that meet your criteria, saving you hours of research. 2. Finding dividend-paying companies. Here are some specific resources you can use to find companies that pay dividends. 1. Financial websites. Many financial websites, such as Yahoo Finance and CNBC, have dedicated pages for dividend stocks. 2. Stock brokerages. Most stock brokerages offer stock screeners that allow you to filter stocks based on dividend yield, payout ratio, and other criteria. These websites and brokerages not only provide a list of dividend-paying stocks, but also give you access to valuable information like a company's dividend history, financial reports, and expert analysis. This data can be invaluable when making your investment decisions. 3. Avoiding high-yield traps. But here's the catch. Don't fall for high starting yields alone. Take Verizon and AT&T as an example. Despite their tempting high yields, they underperformed due to weak growth, excessive debt, and poor fundamentals. High initial yields can be like sirens calling to unsuspecting investors. They might seem attractive, but often they come with high risks. Companies that offer exceptionally high yields could be in financial distress or operating in a declining industry. In the end, they might not be able to sustain those high dividend payouts. 4. Choosing companies with growth potential. The smarter approach? Invest in companies with low starting dividend yields but with the potential for rapid dividend growth, much like what we've seen with Texas Roadhouse. When you focus on dividend growth, you're looking at companies that prioritize reinvesting their earnings to fuel their business growth. This not only leads to increasing dividends but also capital appreciation over time. A great example of this strategy is Texas Roadhouse, which started with a modest dividend yield but steadily increased it over the years. 5. Emulating Warren Buffett's strategy. To emulate Warren Buffett's strategy of accumulating stakes in companies that generate excess cash flow and reinvest those funds, you can follow these steps. 1. Identify companies that generate excess cash flow. Check a company's free cash flow to gauge its ability to generate cash for shareholders. Assess the company's ability to reinvest cash flow. Look at management, competitive advantages, and industry outlook. 2. Companies with strong management teams, durable competitive advantages, and attractive industry outlooks are more likely to reinvest their cash flow at attractive returns. 3. Invest for the long term. Buffett's investment strategy is a long-term one, focusing on companies that have the potential to generate attractive returns over many years. Don't expect quick riches, but rather the compounding effect of your investments. 6. Diversification and risk management. Like with most investing topics, opinions vary on how to build a dividend portfolio. The debate often centers around the number of stocks an investor should own and diversification. Investing is unpredictable, and even seasoned professionals can't predict the future accurately. This is where diversification plays a crucial role. By spreading your investments across various stocks, sectors, and industries, you can reduce the risk associated with concentrated bets. Even if one company or sector underperforms, others can help balance your portfolio. 7. Staying prepared for economic downturns. Building a dividend portfolio for regular income is only effective if your dividends don't get cut. Dividend cuts often happen during recessions when companies with too much debt, cyclical profits, and poor dividend coverage are vulnerable. During economic downturns, companies with high debt levels or those operating in cyclical industries are more likely to cut or eliminate their dividends. To safeguard your income, make sure to invest in companies with strong financials, low debt, and a history of consistent dividend coverage, even during tough times. In summary, building a monster dividend portfolio requires strategic choices, sustainable investments, and a focus on long-term growth. Your path to financial freedom begins here. Don't rush for quick gains. Aim for the steady, compounding wealth that dividend investing can offer. If you found this video helpful, don't forget to like, subscribe, and share it with your fellow investors. Stay tuned for more valuable insights on building a solid financial future. Thank you for joining us today.